You had mutual funds, which is a very large part of a lot of our investment portfolio. How much tax did you pay?
Okay, Drashti, that's a very straight question.
But say there are people or situations where anybody's portfolio is going through major losses. What about that?
I remember the recent activity which we did it for one of our clients. He had a close to 10 lakhs worth of a losses in his direct equity.
10 lakhs.
There's another one of the very good ways of saving taxes.
Anything else apart from this that can help people and that you are doing that we should know? We talk a lot about our investments and growing our money, but we often overlook the tax aspect of it. How much of your return do you actually get to keep? Today, we're unpacking the real cost of investing with Rajani, who has been working in the mutual fund industry for over a decade. Not just risk and return, but taxation and how it impacts your investments. Hi Rajani, how are you feeling today?
I'm doing good. How are you, Drashti?
I'm good, but I'm going to directly dive deep into the question.
Sure.
You had mutual funds, which is a very large part of a lot of our investment portfolio.
True.
How much tax did you pay?
Okay, Drashti, that's a very straight question, but I'll still try to answer it. See, honestly, as a salaried class people, you have a limited scope of saving taxes. So you have a list of deductions like HRA or NPS or ATC.
Right.
So all these deductions when you claim, and if your overall deductions are close to 7,80,000 plus, maybe old tax regime would suit you, else probably new tax regime. So as per that, you have to pay taxes. You don't have any choices over there. When you sit with your CA, probably they'll figure out, they'll help you file better. And coming to a saving taxes, yes, I do save a lot of taxes in capital gains in my personal portfolio.
Okay.
When I'm planning my investments.
So, Rajani, you mentioned capital gain tax, right? What is it that can be done to save tax when it comes to capital gain tax?
Capital gain tax, let me just explain you. When you invest in a mutual funds or equity portfolio, up to 12.5% of our taxes you have to pay on our gains when you book. The regulation also says that up to 1,25,000 of a capital gain, if you're overall booking, there's no taxation. Over and above that, if you have a capital gains, you have to pay 12.5% of taxes. So using this method, there is something called tax harvesting. So again, there are two types of tax harvesting. One is tax gain harvesting and tax loss harvesting. What is tax gain harvesting is, every year you're booking a capital gains worth of 1,25,000 from your portfolio. Just withdraw and reinvest back into your portfolio.
Right, okay.
Yeah.
And what about tax loss harvesting?
Loss harvesting is again, as in when you get the opportunity of a market crash, or you suddenly have a deep corrections in your portfolio and suddenly your portfolio is in a losses, you book your profits and reinvest back in the market again. And why do we do loss harvesting is basically, we have to pay capital gain, we have to pay taxes on a capital gains, not on the losses. When you have a losses in your portfolio, you can utilize this losses and do a set off against the profits.
What I'm understanding is that if I have a loss of X amount that I have booked and say a profit which is going beyond the exemption limit, loss basically gets set off. Okay, and so that is tax loss harvesting as a whole is what I understand. Right. Is there an example that probably you can tell us which will help us understand it better and deeper?
So Drashti, I'm going to explain this with a very simple example so that we understand the harvesting clearly through this example. Assume first year you have a 5 lakh rupees investment. At the end of the year, the 5 lakh rupees amount becomes a 6,25,000. So you have a capital gains of 1,25,000. You withdraw this amount, reinvest back. You back investment again, it could be a same scheme or a different schemes. Now your capital investment is 6,25,000. At the end of the year, assume it becomes 7,50,000. You withdraw that amount again. What is the capital gain? 1,25,000. Reinvest back in the market. You continue this trend every year. Assume that one of the years you have a losses. Market has crashed and there's a losses in your portfolio. Your investment amount is at 10 lakhs. And suddenly there's a market crash, your portfolio has become 9 lakhs. Here what you do is again withdraw and reinvest back in the market. You have a 1 lakh rupees loss in your portfolio on paper. So next year, your investment amount is 9 lakh now. and the market is probably did a really good from there, and you have a portfolio is gained 11,25,000 from 9 lakhs.
Okay.
So your capital gains, you withdraw this money again, your capital gains are 2,25,000. Right?
Yeah.
2,25,000. Now, again, you withdraw and reinvest here. And what is the capital gains that you will pay here? 1,25,000 is exempted. Previous year, you had a 1 lakh losses. So you're going to set off against that. You're again paying a zero tax here.
Oh, so the entire 2,25,000 basically gets
Set off.
Yeah, it's a set off.
Yeah.
Okay, lovely. Wow.
2,25,000 is not a set off. It's a 1,25,000 plus
And the
1
1 lakh, yeah, correct.
is a
Not
set-off.
total, 2,25,000, I'm saying 1,25,000 plus 1 lakh basically.
True.
The loss basically gets set off.
True.
Understood.
Assume this continues. At the 10th year, your total, maybe your value of your portfolio is 16,25,000 rupees. And you require this money for your some personal use and you're withdrawing your funds. If you would have not done this every year exercise of withdrawing and reinvesting, what is the amount of a capital gain taxes you would have paid it? The calculation is the amount of investment amount was 5 lakh rupees. Current valuation after 10th year is 16,25,000. Your total capital gains is 11,25,000. 1,25,000 is an exemption, on that you are not paying any taxes. So your net capital gains is 10 lakh rupees. On 10 lakh rupees, you are paying
12.5%.
12.5%. That is 1,25,000. So you saved 1,25,000 of a taxes, which you would have paid it.
Also, then this becomes an activity to be done every year.
True. But here, what I would like to say is, under mutual fund, it's maybe not very easy because it's a number of units. If you're doing probably SIP or a lump sum investments, you have to calculate exactly number of units to be withdrawn.
That will give you the exemption.
Exemption of a 1,25,000 of a capital gains. So it's always advised to sit with your advisor and get this done. So they'll help you.
We can
with
plan
exact
better.
amount.
Yeah.
Yes.
Yeah. Oh. This is great information to understand about gain harvesting. If I may just ask you, considering I don't think your portfolio is making any losses, but say there are people or situations where anybody's portfolio is going through major losses. What about that? What is that called, and how do you go about saving tax through that?
Exactly. That's called tax loss harvesting. And as you mentioned, we do this exercise for all our clients, and I remember the recent activity which we did it for one of our clients. So his portfolio was, he had a close to 10 lakhs worth of a losses in his direct equity. He had a direct equity stocks in his portfolio.
10 lakhs?
10 lakhs of a losses he had in his portfolio. And plus he also had a mutual funds, of course, in his portfolio. The mutual fund portfolio was a bigger. The stocks was something he was doing it on his own, and as in when he, however he understands, he used to do it on his own. But mutual fund portfolio was quite bigger, and which he was doing it from quite some time. But here under mutual fund schemes, all the schemes were in regular. It was not in a direct. So of course there was a lot of a commission loss which he was losing out on in his portfolio. But even after knowing that, he was not able to move his regular to direct, because when you move regular to direct, there's a capital gain taxes again you have to incur, because his portfolio was from quite some time and had a good amount of gains in each and every schemes. So he was really struggling there. And on the direct portfolio, which direct stocks which he had, however, he wanted to exit slowly all the stocks and wanted to maintain only mutual funds here. So what we did here is we sold all the loss-making, the direct equity portfolio, and we booked close to 10 lakhs of losses in his portfolio. Under equity mutual funds, his portfolio was close to 1.25 crores of his total portfolio of mutual funds. And out of that, the gains were close to 35 lakhs. So here, of course, we had to do a shifting from a regular to direct. So we used this, we booked a profit of 10 lakh, losses of 10 lakhs here. And we moved 1/3 of his portfolio close to from a regular to direct. And we end up paying more or less zero tax, because we had 10 lakhs of losses to set off against the profits of a mutual fund.
Mutual fund. Okay. Oh. So 10 lakhs
plus
got,
close to 20 to 30,000 of a commissions we saved it, which she was otherwise paying in under the regular schemes.
wow, that client is going to stay for sure.
Yeah.
For longer. This does give me a perspective in terms of, gain harvesting and loss harvesting. Apart from this, is there anything else that probably, say, couples should keep in mind, something that you and your husband would be doing together, to save tax?
That's a very good question, Drashti. I've seen many individuals after marriage, especially couples, they start doing everything jointly, opening an account jointly, having investment jointly. I think, according to me, one can avoid that and take the tax benefit individually in their accounts, like the way we discussed, the harvesting, gain harvesting, loss harvesting. All of these can be taken individually, separately, like 1,25,000 per person. Now together in a family, you can take a 2,50,000. Right? So my suggestion is you should do separately rather than a joint account.
So you and your husband might be having a separate account, not even one investment together?
So yes, on my home loan, we are together. We have a joint account over there. The loan is together's name because the property we are holding is together. And plus here, we are taking the tax benefit again together here. The ATC benefit, the principal and the interest component, both of us are utilizing through one property.
Okay, so one is the harvesting piece, second is the loan piece. So that's where you're saving tax. Anything else apart from this that, that can help people and that you are doing that we should know?
Yeah, there's another one of the very good ways of saving taxes by investing in your child's name. A lot of people are not aware of this. You can save up to 5,25,000 of our taxes by having your investment with your child.
5,25,000 like on a yearly basis?
It can be yearly basis actually. I'll explain this to you how it works. Generally, as a parent, we start saving for our kids' education purpose. That's something we always do it on a priority basis. So instead of having those investments on your name, open an account with your child, mutual funds. I'll give you an example of a mutual funds. Open an account with your child and let your child be the first holder. You be the guardian and start investing in their name. Once the child turns 18, so you have to do the re-KYC there. You have to, so then officially after 18, your investment becomes in the child's name. And when you use those money, when you withdraw those money for education purpose, it becomes a tax-free up to 5,25,000. So as per from this year onwards, 25-26 financial year, under Income Tax Act, up to 4 lakh of a minimum income exemption is given and 1,25,000 of a capital gain exemption. So up to 5,25,000 of a income, you're not be eligible to pay any taxes.
All right. So correct me if I'm getting this right or wrong. Okay. At 18, when your son, because he's not earning, and
True.
That's why it gets exempted.
Very true. As any individual, I just gave you an example of a child, any individual having income up to 4 lakh rupees under new tax regime is not liable to pay any kind of a capital gains or any gains, any taxes basically.
Rajani, I have another question coming to my mind, and that's about NPS. Everybody is chattering and talking about investing in NPS and how that helps in taxation. So do you want to shed some light on what is it that you do when it comes to NPS investment?
See, NPS is, first of all, NPS is a very beautiful product. A lot of people have this myth around this product. It's a lock-in for a long-term period, doesn't create a returns. No, it gives you a market-linked returns and plus it saves a lot of taxes. It's a beautiful product for your retirement purpose. There are two types of NPS again. One, which you do it individual from your individual account, which comes under ATCCD 1B. Up to 50,000 of claim you can take it over there, investments. The second one is a corporate NPS, which comes under section ATCCD 2, which is 10% of your basics under old regime and 14% of your basics under new regime. So this you can avail and still save a lot of taxes here.
You can avail both together?
Yes, you can avail both together.
Okay, and is there an option to be flexible where, like you said, new regime is 14% of taxes, right? Say 14% might be too much for me. So can I choose a lower percentage?
Of course, it's up to you. 14% is the maximum limit that you have it. You have option to choose a lesser percentage over there.
Interesting.
A lot of people are not aware of this, or maybe a lot of corporates are not offering this. So my suggestion is the employee should go to their employer and request to start a corporate NPS.
Rajani, going back to your point on tax harvesting, you very clearly mentioned that probably every year you should exit and then again reinvest so that can help you with your taxation. When am I supposed to, exit? Who should I speak to? Because otherwise I'll be lost in this field of mutual funds. I don't know when to exit, when to reinvest.
When it comes to tax gain harvesting, generally it's ideal to do it right before your end of the financial year, which is financial year ends in the March. So you start planning from a Jan or a Feb month. You have to do it before March end. Tax gain harvesting. Loss harvesting is based on the opportunities. Since whenever there's a huge market corrections, you have a negative in your portfolios and you have to book it. Again, I want to stress here, loss harvesting specifically, it's not easy to do it in a mutual funds. You have to do it only through your advisor's help. That's one. And second advice, what I want to give is, I always suggest everybody to start planning from the beginning of the financial year and avoid going to your advisor or a CA at the end of the financial year and ask them to save your taxes and fix everything at the end of the year and save more taxes. That's not possible.
That's me.
So yeah, it's always suggested to start planning from the day one and always go to qualified financial advisor who will give you very unbiased advice which is right for your portfolio.
Right. Coming to the last question, Rajani. When it comes to investments, what are the things to keep in mind so that it doesn't impact one's taxation negatively?
There are multiple products, right? Equity, debt, gold, real estate, a number of products in the industry. So what you need to keep in mind is what is your post-tax returns and your holding period. So this is how I put it across. 3 things you should keep in your mind. So either your returns are impacted with 12.5% of a taxation, or it's based on a slab rate taxation, or what is the investment horizon that you have to hold it that impacts your taxation. These are the 3 things you should keep in your mind while choosing the product. I think that will simplify. Otherwise, the number of financial products in this industry there are n number of products, right? So if you have these 3 things in your mind, so it'll be easy for you to take a decision. Else, my always advise to go to a qualified financial advisor. They'll help you fix this problem for you.
There's always so much buzz about investments, but I don't think everybody thinks in terms of how it's going to impact the taxation, right? A lot of learnings and a lot of takeaways for us to take back from this conversation, Rajani. Especially, when it comes to me, I'm going to think twice in terms of how to plan my taxes better next year so that I actually can attain financial peace of mind. Thank you so much for being here.
Thank you so much, Drashti.
So here are a few takeaways for me. Regularly practicing tax harvesting. Maximizing tax benefits by planning family investments wisely. And availing corporate and personal NPS for maximum tax saving. I hope you all also had enough to take back from this conversation. See you soon.